Good morning, everyone, and welcome to PYA's Summer CPE Symposium, Hot Topics in Healthcare, Day 2. I'm Catherine Good, a principal in PYA's Audit and Assurance Department, and on behalf of PYA, I'm pleased to welcome you to our 4th annual Summer CPE Symposium. PYA is happy to present these complimentary virtual learning opportunities for healthcare colleagues across the country. Over 2 days, PYA thought leaders will present 4 sessions on trending topics and provide key takeaways and helpful tools for you and your organizations. Today's presentations are Tax Planning in an Uncertain Time and After the Breach, Navigating the Fallout of Healthcare Data Compromises. With that, I'm going to hand it over to our moderator for more information on CPE credits for today's presentations.
Thank you, Catherine. As this event is for CPE credit, there are some additional steps that we'll take in order to comply with NASBA's requests. In accordance with NASBA, attendees will be provided with 3 polling questions throughout each of today's presentations. Responses are documented electronically. Attendees must respond to these polling questions within the allotted time in order to receive CPE credit for the presentation. If you encounter any issues responding to the polls, please send your answer into the Q&A pane, and we will document them for your CPE credit. A post-event survey will also be provided for attendees to submit feedback regarding their webinar experience. The polling questions and post-event survey must be submitted for proof of participation today. Credits will only be earned for sessions attended in their entirety. We've posted a PDF copy of the presentation slides for your reference in the Resources pane. Also, you'll receive an email later today with a copy of the slides and a recording of the webinar. You can customize your viewing experience by resizing, moving, or minimizing all of the panes within the webinar.net platform. Your CPE certificates are downloadable via the CPE pane once you have completed the requirements, and they'll also be sent via email after the webinar. You'll have the opportunity to submit questions to today's presenters by typing a message into the Q&A pane of the control panel. We collect these and address them via email after the webinar, and all of the presentations will be recorded and released with a copy of the slides after the event. Please note that registration is still open for the remaining Summer Symposium session. For more information and to register, visit the Thought Leadership section of our website at pyapc.com. Our first presentation of the day is Tax Planning in an Uncertain Time, presented by Joe Engel, Patrick Birmingham, and Victoria Gentry.
Thank you very much, Jennifer, and good morning, everyone. My name is Joe Engel. I'm a tax principal with PYA, and as mentioned, I'm joined by my colleagues Victoria Gentry and Patrick Birmingham, who are both tax managers with PYA. Thank you very much for joining us for today's webinar. I think we can all agree that we are living in a significant level of uncertainty driven by, among other things, geopolitical conflicts, economic volatility, social unrest, and potential impacts of emerging technologies like AI. Additional uncertainty, and the focus of this webinar, is caused by the recent imposition of additional tariffs and changing tax legislation. To scratch the surface of this, today we will talk about uncertainty as a result of the recent change in the presidential administrations, the budget reconciliation process, which is used to facilitate the passing of tax legislation, especially considering the nearly equally divided Congress, select provisions from tax legislation currently working its way through the House and Senate, as well as tariffs, because of course no tax webinar these days would be complete without a mention of tariffs, and perhaps it's especially relevant to this webinar considering the impact to so many of you due to the number of critical healthcare goods and supplies imported from China and other countries subject to the tariffs. With different administrations often come different philosophies. The Tax Cuts and Jobs Act, which was enacted during President Trump's first administration, is an example of a supply-side approach to legislation focused on incentivizing investment across the economy. On the other hand, the CHIPS and Science Act, as well as the Inflation Reduction Act, enacted during President Biden's administration, followed an industrial policy approach which incentivized investment in specific industries, namely semiconductors and renewable energy. Now that President Trump is back in office, he is looking to extend the tax cuts made during his first administration and at the same time undo some of the green energy incentives enacted during President Biden's administration. Later in the presentation, we'll see how timing of certain renewable energy investments would be impacted by currently pending legislation. And because a president can try to reverse initiatives of previous presidents, this creates a significant level of uncertainty and the ability to only temporarily plan business operations under a particular regime. Next, we'll talk about the budget reconciliation process, which was created under the Congressional Budget Act of 1974 with the purpose of expediting tax, spending, and debt limit legislation with a simple majority vote bypassing the 60-vote filibuster threshold in the Senate. Because filibuster is used to continue debate over a bill and prevent it from getting to a vote in the Senate, and 60 votes are required to cut off that debate, filibuster effectively creates a 60-vote supermajority requirement to pass legislation in the Senate. The reconciliation process, however, is used to avoid filibuster, but it is available for matters affecting revenue, spending, and debt limit only. As I mentioned, the reconciliation prohibits provisions that do not affect spending, revenues, or the debt limit, and or that add to the deficit outside the 10-year budget window. Extraneous matters are addressed through a process known as the bird bath, which was mentioned during our webinar yesterday. And what wasn't mentioned is that some people refer to the provisions that have been removed by the process as bird droppings. Current Senate parliamentarian who presides over this process is Elizabeth McDonough. Revenue, spending, and debt limit may be considered in a single reconciliation bill or multiple bills, up to one for each of the subjects. This year, Congress is considering all three subjects in what has been called the One Big Beautiful Bill. But the tricky part of reconciliation, because it prohibits provisions that add to the deficit outside the 10-year budget window, it typically contains provisions that expire after several years, or so-called sunsetting provisions, extending into the future and historically different administrations. But the non-sequential terms of President Trump mean that he now has a multitude of expiring and very popular provisions from the Tax Cuts and Jobs Act to negotiate over the next several months. Several of the sunsetting provisions pertain to, from an individual tax perspective, lower marginal tax rates, expanded standard deduction, and higher estate and gift tax exemptions. From a business perspective, qualified business income deduction under Section 199A for pass-through businesses, as well as the employer credit for paid family and medical leave would expire after this year. Temporary bonus depreciation would be available through the end of 2026, but expire thereafter. And the base erosion anti-avoidance tax, or BEAT, the foreign derived intangible income, or FDII, and the global intangible low tax income, or GILTI, would be modified in tax years beginning after this year, December 31st, 2025. And that leads us to our first polling question.
All right, our first question is, of the expiring provisions of the TCJA, which one do you or your business most want to see extended? Lower tax rates on individual taxable income, increased estate and gift tax exemptions, bonus depreciation and other capital expensing options, lower rates on international business tax provisions like GILTI, BEAT, and FDII, or pass-through business deduction under Section 199A. Remember, you must fill out the polling questions to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand it back to the presenters.
It looks like all of us would like to continue with lower individual tax rates, which is probably expected. In the next section of the webinar, we will discuss several provisions of the currently pending legislation, which is referred to in the House bill as the One Big Beautiful Bill Act, and as several colleagues of mine, in particular Marty Ross, refers to as OBBBA, which doesn't necessarily flow off my tongue very clearly, so I prefer OB3, which I've heard from others, but you can take your choice. The One Big Beautiful Bill is Title 11 of the House bill, and the headings of the slides that follow that are in quotation marks are the names of the specific subtitles of that Title 11 of the House bill that include the provisions that we will cover. Also, please note that on Monday evening, the Senate Finance Committee released its version of the legislation, which differs from the House bill in many ways. While we are still understanding the Senate version that was released, we will try to highlight certain differences as we go through. And now I will turn it over to Victoria to go through several of the provisions.
So looking at some of these provisions, we're going to start off by talking about the individual provisions, which is what most people indicate that they cared about. So when looking at these individual provisions, it's important to keep them in context, what will happen if a bill is not passed, but also what is in both versions of these bills. As Joe mentioned, there are several differences that came out in the Senate version on Monday night. So the slides are going to reflect what was in the House version, but we will also be talking about the Senate provisions. So when looking at these tax rates, obviously, if we do not pass a bill, these tax rates are going to go up to a maximum income bracket of 39.6%. With the bill that is currently proposed, both in the House and the Senate, that maximum tax bracket would stay the same as it currently is at 37%. Now, it is important to note that in the Senate version of the bill, the three lowest tax brackets, so that 10%, 12%, and 22%, are going to be adjusted for inflation, and there will also be an increase to the standard deduction in the Senate version of the bill for inflation. Now, talking about that standard deduction, if we were to not pass a tax bill this year, we would see those standard deductions drop back to what they were in 2017. And that is going to be $8,350 if you are a single filer versus $16,700 if you are married filing joint. With the House version of the bill, these would permanently increase to $15,450 or $30,850 for married filing joint. The Senate version does allow for these to be increased over time with inflation. Now, I'm going to talk about the itemized deductions that without a bill would still be allowed. With a bill, it's going to look a little different on the next slide. But one of the important provisions is the SALT cap. Without this bill being passed, the SALT cap would actually be removed. In the House version of this bill, there is a $40,000 cap, whereas in the Senate version, it is maintaining the current $10,000 SALT cap. There have been multiple senators, both on the Republican and Democratic side, that have expressed that they feel that this $10,000 in the Senate version is just a current placeholder for now, and that it's most likely that they would like to see the $40,000 that the House negotiated be included in the final version of the bill. And then I also do want to mention, even though it is not on this slide, that the House version of the bill does repeal the pass-through entity tax deduction for specified trades or businesses, while the Senate version of the bill just limits that deduction to $40,000. Now, there are several provisions that are looking to be made permanent within both versions of the bill, although there is a little bit of differing language between the two sides. So first up is a popular one, which is the Qualified Business Income Deduction, or QBI deduction, also known as Section 199A. In the House version of the bill, they not only made this a permanent deduction, but increased the deduction from the current 20% up to 23%. Now, this was a very important change as it's affecting sole proprietorships, REITs, PTPs, but also because of that increase and because of the way that they have structured the limits of phase-ins for high-income earners, it actually ends up reducing the effective tax rate on this type of deduction from 40.8% as an effective tax rate for the highest income earners, down 8.5% to 32.29%. As we know, the president is involved in real estate, and so he is always very pro anything that would help those in real estate. Now, when it comes to the Senate version of the bill, they did not increase the current deduction from 20 to 23%, so they have maintained that 20% level. But what they did do is that they increased the wage limitation to $75,000 for single filers or $150,000 for married filing joint. When it comes to a very popular one, which is the estate and gift tax exemptions, they would be making permanent the $15 million in the lifetime exemption amount for single filers, $30 million in the case of married filing joint. But when it comes to the Senate version and the House version, this is allowed to be adjusted with inflation. And so this will go up. It's something that a lot of people are very passionate about, even though many of the people that are passionate about it aren't necessarily going to be affected by this. It is a popular thing to see happen in times of the Republican-controlled House and Senate. Now, I mentioned about the deductions when it comes to eliminating the itemized deductions. This is a great opportunity for tax planning where we can use various types of directed trust in order to group together deductions, because we have a permanent repeal of the piece limitation in both the House and the Senate version of the bill. What the piece limitation was is that it limits the deductions that you are allowed if your income exceeds certain AGI thresholds, and it limits it to either 3% above the threshold or 80% of the deductions that you would be allowed. And so what this means is if you had an AGI that was $200,000 above the threshold with $100,000 in itemized deductions, you would be looking at only being able to take the lesser of 3% of that $200,000, which is just $6,000, or 80% of that $100,000, which is $80,000. So under piece, you've only been allowed to have $6,000 of itemized deductions. That is going away in both versions of the bill. Now, with the House version of the bill, they have offset this, as I mentioned, with the permanent elimination of the miscellaneous itemized deductions. The Senate version does it a little bit differently in that it allows you to have itemized deductions, but only at 35 cents per dollar that would otherwise be allowed for those high income earners. Now, the Senate version of the bill did introduce a charitable deduction of $1,000 for single filers or $2,000 for those who are married filing joint. And that is even if you are not itemizing. And then the final big mention of permanent enactment is the permanent enactment of the excess business loss limitation rule. Now, this is a rule that was actually introduced under President Biden, and he introduced it in his Inflation Reduction Act in 2022, and that limits the pass-through entity business losses that you can take in a year. So it's very interesting to see that even though this is a Biden policy, it is one that they are wanting to maintain. Now, of course, with that being said, there are a number of new provisions that are occurring. One of the big provisions that President Trump campaigned on was the elimination of no tax or tips on overtime. This doesn't actually mean that there's no tax or tips on overtime. There are limits with that, and there are differences between the bills, but also it also doesn't mean that as accountants, we can just structure to have a law of overtime or tips and avoid paying taxes. These are going to be limited to traditional overtime and traditional tip industries. So that's looking at for tips industries such as food and beverage service, your nail technicians, your hairstylist, and there is also minimum wage considerations to be applied for this. Another thing that has been brought up with the overtime is that they will need to do a little bit of redesigning on the W-2 form to make sure that overtime is specifically pulled out. With both overtime and tips, there has not been specific guidance on how necessarily that needs to be calculated moving forward, as it has been said that you are able to use any reasonable method. So that means that the IRS will eventually need to provide additional guidance on that. Now, within this no tax on tips on overtime, you are limited in that you cannot be a high earner. In the House version of the bill, this means that you cannot earn over $160,000. In the Senate version, it means that you cannot earn over $150,000. And additionally, neither version of this bill is making it permanent. So you need to keep in mind that these are only going to last through the end of Donald Trump's second term in 2028, at which point the no tax or tips on overtime is going to go away, assuming that it is not permanently enacted in a later tax bill. Now, the other thing that is important is that in the House version of this bill, there was no limitation on how much tax or overtime that this would apply to. In the Senate version of the bill, you are limited to $12,500 of tax-free overtime and $25,000 of tax-free tips. Now, that means income tax free. It does not mean that you are free from all taxes, as both Medicare and Social Security taxes will still apply. The senior deduction for those who are over 65 and making under $75,000 in their modified adjusted gross income is $4,000 in the House bill. This was actually increased to $6,000 in the Senate version of the bill. And so this is yet another example of a provision that if the current version in the Senate passes, the House and the Senate will have to come together and decide what is going to be the final version of the bill. Is it the 4,000 or is it the 6,000? Now, a very popular new provision is the above the line deduction for car loan interest. Now, this is only up to a max of $10,000 of interest, and then you are going to be reducing that deduction by $200 for every $1,000 that your modified adjusted gross income is over $100,000 or $200,000 in the case of married filing joint. And in addition, the Senate version has put further limits on what actually would qualify for these car loan interest. And so it's really specifically meant to be your passenger vehicle that you're using, not a recreational RV, not buying a fleet of vehicles to use in business. These are meant to be for your personal use. And then the final new provision that is introduced in both versions of the bill, and in both versions of the bill, this is actually an identical provision, and that is the Trump accounts, which were initially called the MAGA accounts in the initial version of the House bill before we had some management amendments. And what these are is that these are private trust accounts meant for U.S. children. The idea behind them is that those who have savings accounts, there is a correlation between those who were provided with savings and lower crime rates and greater success in careers. Now, that does not necessarily mean causation, but it is a correlation that they are trying to take advantage of. And so for qualifying newborns, the federal government will contribute $1,000 into one of these accounts. It is also something that you as a parent could set up for young children who were not newborns at the time, although there is a restriction on how young those children can be, and you'd be allowed to set up this type of account. And there's a contribution limit of $5,000 per annum. Now, what is very interesting in these accounts is that when it comes to tax exempt entities, as long as they are not multiple tax exempt entities that are related, that they are not subject to that $5,000 limit. And so there are other restrictions, such as if a tax exempt entity is giving to 3 children that live in the same house, they have to give the same amount to each of those 3 children within that same address. But also there are limits to what these accounts can eventually be used for once the child turns 18. They are limited to education expenses, to small business expenses if they are starting a small business, or to home purchases. As the idea behind these accounts is that it will help children be able to have a stronger chance at a good future later on. And then the final area that I'm going to touch on, moving into some of the business provisions, and PJ will get more into some of these business provisions next, is looking at various things that are occurring with depreciation. So when it comes to bonus depreciation, the House version of the bill reset bonus depreciation to being 100% between tax years 2025, starting on Inauguration Day, and then up to through tax years 2030, 2031, depending on which type of property was being used for bonus depreciation. And unlike the initial TCJA bonus depreciation provision, where there was a phase out where we dropped down to 80%, 60%, 40% this year, there is no phase out in terms of that percentage dropping off. So it will be 100% the entire time based on the House version of the bill. I say House version specifically because of the fact that the Senate version actually makes the 100% bonus depreciation a permanent provision in their version of the bill. And then the other thing to note is that if you did place property in service between the 1st and the 19th of this year, they are not qualified for the 100% bonus depreciation. You will be looking at the 40% bonus depreciation there. There is also a large section talking about qualified production property. Now, what this is that it is non-residential real property that is involved in a qualified production activity. We do know that this will exclude things such as office furniture, but we will need further IRS guidance in order to determine exactly what a qualified production activity is under these new regulations. And then, as is the case with the qualified production property, as well as with 179, a cost seg study can be very, very useful in terms of having your needed proof if you were to receive an audit on your tax return. Now, when it comes to 179 expensing, for this area of depreciation, they have increased the limit that you are allowed to use up to $2.5 million, as well as the single item phase out has been increased to $4 million. This is the case in both the House and the Senate version of the bill. You are still not able to create a loss with 179, which is why bonus depreciation is something that is very advantageous to take advantage of for items that are qualified for bonus depreciation. So for instance, real estate improvements we can't necessarily put under bonus depreciation. They would need to go with section 179. But there are other benefits to 179 depreciation as well. All types of depreciation have their own rules, particularly when it comes to selling those items later on and having to think about depreciation recapture. So if you are a business that is looking at adding large amounts of assets, this is definitely a conversation to potentially have with your tax preparer to discuss what's going to be the best route and if a cost seg study is going to be advantageous for you to perform. And with that, we will now move on to the second polling question.
Thank you. The second question is, what would be the one strategic thing you would change if you could be the IRS commissioner for one day? Modernize the tax filing system for greater efficiency and accessibility, increase staffing for taxpayer services to reduce wait times and improve support, simplify the Internal Revenue Code to reduce compliance burdens, expand proactive taxpayer education and outreach, especially for underserved communities, or enhance transparency and consistency in the audit selection and resolution process. Remember, you must fill out the polling questions to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now back to the presenters.
All right, so we're going to kick this off with a topic that I think a lot of us were hoping there was going to be some good guidance on, and that is going to be the research and development costs. I will start by saying this is only going to focus on domestic R&D costs. The foreign aspect has not changed. That is going to remain the 15-year capitalization and amortize over that time period. But so this first slide and a lot of the slides I'm going to have are kind of going to show you what the current law looks like, and then we're going to look at what the provision is actually going to do to change that law when signed. So currently, beginning in 2022, taxpayers must capitalize and amortize all research and development expense over a 5-year period. Additionally, further guidance has been released that software development costs are also going to be classified as R&D costs. We could probably have a whole hour-long CPE session on what is a software development cost, but we'll probably save that for another time since we have a lot of better material to get through here. But so the example below is going to say how the current law treats this. So we have a taxpayer in 2024 that had $457,000 of R&D costs. So as you see in the book column right there, that's going to be added back. So that's not going to be an allowable expense. It's going to be capitalized and amortized over 5 years. So even though we say 5 years, it's really spread over 6 because the first year, which would be 2024, and the last year, which would be 2029, are only going to get a 10% benefit. So as we see in the column on the right, we have a $457,000 add back with an additional $45,000 expense. So in 2024, you're going to see an unfavorable M1 item of $411,000. Now, 2025 through 2029, if there is no more R&D, this would just be a pure tax amortization expense that would reduce taxable income. But as you can see, that very large add back in the first year is something a lot of taxpayers have been frustrated with, and this bill is going to identify some things to help fix that. So what is going to be fixed? So currently it is going to create a new code section 174A, which is going to allow for immediate expensing of these R&D costs. This is one of the slides that's going to have a House bill showing that there's an expiration date of December 31st, 2029. In the Senate, this is going to be made permanent. So the House bill was showing an expiration. The Senate bill is going to be showing a permanent allowance of expensing R&D expenses. Now, you can still make an election to capitalize R&D over 5 or 10 years. This is really going to be for companies that are in the startup phase and they just have not a lot of revenue they have a lot of expenses besides R&D. I know with the TCJA, it was difficult for taxpayers to only be able to use 80% of that NOL to offset future earnings. So that's something you want to consider here is, do you want to continue to capitalize and amortize these expenses, or do you want to expense it all in 1 year, but knowing you may run into the risk if you're in a low revenue cycle right now, that offset of future earnings is going to be limited only up to 80%. So talking a little bit more about Section 174A, this is also going to keep the definition that software development costs are research and development costs. So those can be expense as well. I know that second slide has an expiration date. So again, just remember that this is going to be a permanent provision, but this is saying that research development costs will be reduced by Section 41 research credits. And then another very good news coming out of this bill is this is going to be an automatic accounting method change. So there's not going to be a Section 41A catch up. There's not going to be a 3115. This is going to be an automatic accounting method change that will be filed in tax return. So as well as this, the Senate also released some guidance that if a taxpayer has a gross receipts threshold of less than $31 million, they're actually going to be able to retroactively apply this provision. And what that means is they will be able to go back to their 2022, 2023, and 2024 return and amend those to actually immediately expense that R&D. So for C corporations, that would mean cash back refund. For pass-through entities, that would be getting amended K-1s and then going through the amended process for this. This is also something that states are going to have to start conforming to again. Like some states, my home state of Tennessee actually decoupled from R&D. So this provision would actually be matching up with Tennessee. Another thing is, and this is for all my ASC 740 lovers out there, you're going to have to worry about your deferred taxes also. The last two slides, we've shown that there's many different ways to approach this. Retroactive expensing, current expensing, continue to capitalize and amortize those assets. So you just want to make sure when you're undergoing your audit and when you're working on your income tax revision, you think about the best way that you want to treat that. If you want to continue the book and tax difference, if you want to stop your book and tax difference, and just know that that's going to have an effect on your deferred tax expense for the year. Move on. Okay, and continuing the threshold. So we're going to talk about small manufacturing businesses. So under the current law, taxpayers with an annual gross receipt below $25 million over the prior 3 years are permitted to use the cash method of accounting, are exempt from the cap on business interest deductibility, which is Section 163J, and are exempt from the requirements to account for inventories and certain capitalization rules. That's going to be Section 263A. So this $25 million threshold is indexed for inflation, and in 2025, it is currently going to be $31 million. So the provision is going to increase this gross receipt threshold substantially. So it's going to go from 25 million to 80 million. This change is going to apply to December 31, 2025 and beyond, so that 2026 tax year. So that 80 million will be indexed for inflation and will be $100 million in the tax year 2026. Last bullet point is just defining what a manufacturing taxpayer is. So that's going to be a taxpayer that derives substantially all of its gross receipts over the prior 3 years from leases, rentals, licensing, and then sales and disposition of property that is produced or manufactured by the business. So diving in a little bit more on Section 163J, again, this provision is actually going to be made permanent. That first bullet point is saying that the House is actually going to, this is set to expire for the 2030 tax year. The Senate has made this a permanent item. But the big difference is in the second bullet point is we are going to be moving from an EBIT calculation to an EBITDA calculation. So the graphic on the right kind of shows how that's going to work out. So we're assuming same taxable income, same amount of interest expense. In the 2024 column, you'll see that there is no depreciation or amortization add backs. We just have NAs there. So that's going to relieve a $700,000 adjusted taxable income. The 2025 calculation, which would be the EBITDA calculation, we would be able to add back $550,000 of depreciation and amortization expense, increasing our adjusted taxable income substantially. After worrying about the 30% ceiling, you can see in the interest expense carryover, there would be $165,000 of extra interest expense that would be able to be deducted just by changing this from an EBIT to an EBITDA perspective. Another thing to think about here is if you are a current taxpayer that is limited by Section 163J and have been for a few years, and you have carry forward interest expense that has been disallowed, you cannot deduct that again until you are subject to 163J and have the adjusted taxable income to offset that. And why that's important is the threshold is going from $31 million to $100 million. So if you're a taxpayer that's sitting in that $40 to $50 million average and you have multiple years of disallowed interest expense, yes, this provision is going to allow you to be able to deduct that interest in the current year, but you have now years and years of interest expense being carried forward that you're not going to be able to deduct because you won't be subject to that anymore. So another income tax revision talking point here is you're going to have a deferred tax asset that if you do not see your company gaining the gross receipts up to that $100 million threshold, you're going to have a large amount of disallowed interest from a deferred tax asset perspective that's going to be continued to carry forward on the deferred roll forward. So that's another item you want to discuss with your auditors and income tax revision preparers is, do you want to leave that deferred tax asset on the books, or do you want to have some sort of other adjustment to reduce that, knowing that on the rate rec, you're going to see that come through as a deferred tax expense. So this is a slide, thankfully, where the House and Senate have no changes. So this is going to be charitable contributions by a C corporation. Current law is corporate taxpayers are allowed a deduction for charitable contributions up to 10% of taxable income. And as we all know, if you have a deduction without taxable income, that will carry forward to offset future earnings. Within this provision, that 10% ceiling is going to stay in place, but what it's also going to do is add in a 1% floor. So for a corporation to have an allowable deduction on their tax return, their contributions are going to have to exceed 1% of taxable income and stay under 10% of that ceiling. So that final bullet point is discussing how this is going to work. If you have contributions in excess of that 10% ceiling, it's going to be carried forward for 5 years. However, if you have disallowed contributions under the 1% floor, those are going to be carried forward, but only are going to be an allowable deduction if in superseding years you have a charitable contribution that exceeds 10%. So that's going to be an item that you want to be very careful on carrying forward and keeping track of your support, because you're going to be able to have different deductions at different stages depending on one, if you have the income level to absorb these deductions, and depending on if you are under or greater than the floor or ceiling of these deductions. All right, talking about opportunity zones. So this first slide is going to be discussing what is an opportunity zone. So this was a TCJA policy that was used as an economic development tool to revitalize distressed communities across the country. More simply put, opportunity zones are census tracts that meet the definition of a low-income community. And then qualified investments are made in these low-income communities and provide tax benefits. The investments in these opportunity zones are going to be made through qualified opportunity funds, or QOFs. Those are going to be pass-through entities. And this initial round from the TCJA had a max investment term of 10 years. So currently, in how this is operating is a 10-year window, like I just mentioned, and investors are provided with 2 tax benefits by investing in those QOFs. So the first is going to be a deferral on their capital gains that are rolled over from non-opportunity zone investments into opportunity zone investments, again, through that QOF vehicle. And the QF vehicle is going to invest in that low-income community. So if the first benefit here is those taxes are not realized until 2026, or the earlier if you decide to sell or dispose of that asset. So if you do not sell that asset, you will not have a capital gain event until 2026. However, while continuing to hold those investments, you're going to get a step up in the basis of those capital gains. So if you hold those for 5 years, you're going to receive a 10% step up basis. If you hold it for an additional 2 years, you'll receive an additional 5% step up in your basis for a total of a 15% step up in your basis of capital gains. So if you decide to sell before the 10-year mark, your basis and your capital gains has increased, which will lower the taxable income hit on your tax return. And then as that final note says, if you hold the investment for all 10 years, you will have no capital gains. You will receive a permanent exclusion of taxable income on your investment in the QOF. So what is this provision going to address? So it's going to create a second round of opportunity zones that maintain the same designation process. There's going to be a little bit more reporting required than was under the TCJA, but it also is going to add that 33% of opportunity zones are going to have to comprise of a rural area. So this rural area is very simply just adding an R in front of QOF, and the investments must be made in a rural area. What's different also about this RQOF is versus what I initially just said, the normal QOF receives a 10% step up in the basis when held for 5 years. Our QOF will receive a 30% basis step up. Again, when held for additional 2 years, you will receive an additional 5% step up. So in an RQOF, if you hold the investment for 7 years, you will receive a 35% step up in your basis versus a 15% in a normal QOF. Again, RQOF is going to be the same as QOF, whereas if you hold the investment for 10 years, you're going to see a permanent exclusion of capital gains. The final bullet point is another item the House has changed. So in the House bill, it was set to expire on 2033. So there's just going to be a second round. What the Senate has said is it's going to be permanent in the fact that there's going to be continuous round after round after round. So after 2033, there will be a third round that will go on for 10 years, and then so forth and so forth. All right, moving on to 1099 reporting. I know this is a big talk right now out there. So third-party settlement organizations, let's say Venmo, for example, they're going to issue Form 1099-K to participating payees receiving gross payments exceeding $5,000 for goods and services, regardless of the number of transactions. So this threshold is going to decrease to the current year of $2,500 in 2025, and then in 2026, it was going to drop to $600. So what this provision is going to do is modify the requirements for this reporting purposes, and it's going to move to a and/or. So it's going to be $20,000 or 200 separate transactions in a taxable period before that third party will send you a 1099-K. So this is where the House and Senate bill, I think, just for my slide purposes, has kind of differed a lot. So this slide is going based off the House bill. So there's a termination of green energy provisions as of December 31, 2025. And we can see these 5 here below: the clean vehicle credit, the alternative fuel vehicle refueling property credit, say that 5 times fast. There's the energy efficient home improvement credit, residential clean energy credit, and the new energy efficient home credit. What differs about the Senate bill is these are set to expire as soon as 90 days or 12 months after the date of signing of this bill. So all of these in the House bill set to expire on December 21, 2025. With the Senate bill, depending on when it is signed, could be 3 months after, or you could have up to 12 months to take advantage of this credit. These are the 2 biggest credits that are going to change between the House and the Senate, and just in totality, disregarding House or Senate provisions. So the clean energy production and investment credit. So the bill is going to terminate on a delayed basis these 2 credits. What the House bill is going to do was that second bullet point, which is 60 days after enactment of the final bill, construction had to begin and facilities had to be placed in service on or before December 31st of 2021. What the Senate has done is said, depending on when the facility is placed in service, actually is going to be a reduction in credit. So if you placed it in service closer to that December 31st, 2028 mark, you're going to see a 60-40-20 is going to dwindle down by 20% off of that basis of 100% credit. And then it's a note here that advanced nuclear facilities are not going to be subject to elimination of this credit. There's some more foreign stuff on here we did not include, but essentially House and Senate bill both both address it's foreign entity concerns, so investment from foreign entities. If there's investment from foreign entities, it's pretty much going to be that the credit is going to be reduced to zero. So it's really trying to focus in on domestic investment in energy before the cutoff. And finally, touching on a little bit of the tax-exempt entities. So this first bullet point is going to touch on the excise tax of excessive compensation. So the current law is there's an excise tax placed on the top 5 highest paid employees. So all of those are going to be above $1 million. The provision is actually going to change this to the excise tax is levied on any employee that has an excess of $1 million compensation, not just the covered employees, which I just mentioned is the 5 greatest employees. There is a cutout. If you receive excess compensation of $1 million and you are a medical service provider, so if you're a surgeon or some sort of medical provider, you are not going to be subject to this excise tax. So it's really going to be for your CEO, CFO, and then any other non-medical service providing employees who are going to be above that $1 million threshold. They're also going to increase the unrelated business taxable income of these tax-exempt organizations. So the first one is going to be any amount paid or incurred for qualified transportation fringe benefits. Simply put, this is the parking tax from a few years ago that was taken away. This is becoming revamped now, and there's a lot of frustration about this coming back. Other items that are going to increase UBI is going to be income from sale or licensing of a name or logo of an organization, and then also income generated from a non-public research organization whose tax-exempt purpose is to provide publicly available research. So those 3 bullet points, with the first one being a real driver right now in the tax-exempt community, is all going to increase tax-exempt UBI. And with that, we are going to move on to our final polling question.
All right, our third question is, what is your primary concern as it relates to tax legislation and budget reform? Front-loaded benefits and legislation mean that the future budget reconciliation bills can remove revenue raisers, causing the budget deficit to grow exponentially. The short-term nature of legislation makes it extremely difficult to do long-range tax planning. The budget reconciliation process allows parties to cater to their constituencies, sometimes through regressive policies, while continuing to defer true reform, or all of the above. Remember, you must fill out the polling questions to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now back to the presenters.
Thank you. Now we'll cover very briefly, as we have only about 5 minutes left in the webinar, some of the legislation's international tax provisions. As we mentioned, the slides reflect the House bill. I'll also try to mention Senate Finance Committee version as we go through this. I will note that I've seen in the press that several senators were very surprised with the Senate Finance Committee version of the bill, so it suggests that there might be a lot of negotiation to do. As the slide shows, several of the provisions in the House bill refer to the Foreign Derived Intangible Income, or FDII, Global Intangible Low Tax Income, GILTI, and Base Erosion Anti-Abuse Tax, or BEAT. Those are provisions that were added by TCJA and would change at the end of 2025, going into 2026, with the deduction for FDII reducing from 36.5% to 36.5%. Instead of, under the current law, it would change to a deduction of only 21.875%. So that results in a tax rate of it will go to 13.335% effective rate on that income that was set up as an incentive to encourage domestic corporations to hold intellectual property and keep the profits from that sales of those goods and services in the U.S. GILTI is a complementary provision. You can think of FDII as the carrot to incentivize IP in the U.S. and GILTI as a stick to discourage holding IP abroad. GILTI, however, under the regime, there is a deduction currently for 50% that ends up reducing, that gives rise to a tax rate of 10.5%, which is half of the corporate rate. That under the House bill would change to 49.2% and would result in a tax rate of 10.7%. The Senate Finance Committee versions would change these quite significantly. The deduction for FDII would be reduced from 37.5% to 33.34%. A strange number, but it gives rise to an effective rate of 14% for years starting after January 1st. There are several other changes that the Senate Finance Committee version would make. And if you have questions about that, we can help you answer those. In terms of GILTI, the Senate Finance Committee version would reduce the deduction not to 49.2%, but it would reduce it to 40%, giving rise to an effective rate of 12.6%, which with a provision under GILTI that limits the amount of foreign tax credits that are taken, it's so-called foreign tax credit haircut, would get the rate to 14%, which is the same as FDII. Sorry, I'm going through this quite quickly because we don't have a lot of time left, but BEAT is a provision that is essentially a minimum tax to try to prevent foreign companies or domestic and foreign corporations operating in the U.S. from shifting profits to related parties overseas. It only applies to large multinationals making gross receipts of 500 million or more, and it's significantly challenging to deal with for many multinationals. Another significant provision that would be added in both the House and Senate bills, but with differing provisions, is Section 899, which is intended to retaliate against foreign countries for unfair foreign taxes. There are significant differences between the House version and the Senate version, and those will have to be dealt with in negotiations. We're also going to talk a little bit about tariffs. Again, we have only a minute or so left. So tariffs, we have a situation where we have to look at the classification, country of origin, and the valuation, which are three variables that are used to calculate the customs duty or tariffs. And those three variables would be considered in trying to determine mitigation techniques, which would include reviewing the classification, country of origin, and the valuation to try to find ways to reduce the tariffs that would otherwise be imposed. You could also look at techniques of duty drawback or exclusions or exemptions. And I apologize, I'm going through this very quickly, but we're at the end of the presentation. If you do have any questions about this, I'm more than happy to answer them. Please take a look at the slides. And again, if you have questions, please send them to us, but I'll have to turn it back over to the moderator to close us out. Thank you.
Thanks to our presenters, Joe Engel, Patrick Birmingham, and Victoria Gentry. If you have any questions, their presentation and contact information will be emailed to you along with a recording of today's event. Also, if PYA can help with audit, tax, compliance, valuation, or transaction services, please call or email us. You may also visit our website at pyapc.com for more details about our specific areas of expertise or to subscribe to receive PYA insights. Please remember to stay on the line once the webinar disconnects to complete a short survey for CPE credit. Our next presentation is After the Breach, Navigating the Fallout of Healthcare Data Compromises with Barry Mathis. This presentation will begin at 12:30 Eastern Time. If you've not yet registered, please visit us at pyapc.com to register. On behalf of PYA, thank you for joining us. We hope that you'll rejoin us shortly for our next presentation of PYA's Summer CPE Symposium, Hot Topics in Healthcare. Have a great rest of your day.